Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us as we come to you each and every week on Saturday and Sundays, trying to bring you information about mortgages, about real estate, what's happening in those two specific worlds, and trying to marry what the chaos is in the either the economy or the world or what's happening, and boil it down to whereby the simple is usually the best, and we try to do that with the guests that we bring on the show. We talk about products. We talk about the different solutions that you might have. I just got a call recently, about an hour ago, from a company that I worked with down in Texas, talking about down payment assistance programs and how they work in different areas in different states. Here in Southern California, San Bernardino and Riverside counties. Hi, everybody out there. Welcome by KCAA. If you want to see the show, hear the show, you can go to kcaa.com, and you can also hear us on YouTube. If you go to YouTube, Jeff Barton, the Mortgage Voice, as well as our terrific way that you can get in touch with us through our website, themortgagevoice.com. Anyway, this program down in Texas is a lot like what we have here in California. We have Cal Halfa here. We have Chinova. Both of these programs are available statewide, and in specific counties there are down payment assistance programs. Now, a lot of these programs are designed to help first-time home buyers. Usually it's an FHA product. Usually it's something that will aid you in the down payment. Now, as we all know, over the last 3 to 5 years, home prices have really skyrocketed and continue to go up at 3 to 5% this year alone. That's a lot. If it 35% over the last 3 years, that's basically on average what home prices have gone up, and that's a lot. So if you're looking for an FHA loan and you just don't have the down payment, even though it's only 3.5%, hey, 3.5% 5 years ago was a $500,000 loan out in San Bernardino Riverside. Now it's a $750,000 loan. That means that 3.5% that you come up just got shot up by $10,000. If you don't have it, you're out of luck, even though you might be able to afford the monthly payment. How are you going to make up the difference? Well, that's what we're talking about, the down payment assistance programs. And these programs are really about trying to get you into a property. You know you can pay for the monthly. It's the down payment that's killing you. These are the types of programs that help. So in talking to this person who was not in this state, is down in Texas, and trying to get them to understand, hey, look, we have licenses down as Malibu Funding down in Texas as well as different states, but in California we run it a little bit differently, and as I said, there are county programs, statewide programs. They were very, very thankful that I was able to hook them up with some people down in Texas to be able to aid them, but right now we don't have those types of programs here that they offer down there, and their particular down payment programs are awesome. So anyway, we're always trying on the show to be able to help you. And these are types of things that you may or may not know about it. A lot of people think that there's no way that you can get down payment assistance help, and of course there is. Now, some of the programs, yes, it's true. The fund that funds these is a yearly allotted money from the state. When that money runs out, you're done. You got to wait for the next year. So getting into these programs, talk to the loan officer, talk to the people who are doing your loan. Sometimes these programs are hooked up through banks. Sometimes a loan officer at a mortgage bank or a mortgage broker can help you. All of these things are true with Malibu Funding. If you want to go to the website, malibufunding.net, you can see the numerous loan officers there who are all licensed, ready to help you. And, that's kind of the way it is. Let's get into a little bit of what is happening on rates. You may have noticed, and anybody who is looking for a house right now who has yet to lock in a rate is unhappy because the rates keep creeping up. I think last week we were in the 7.2. Today we're at 7.3, 7.31. Now, obviously 10 basis points may not seem like a lot, but after a month or 2 months, it's 40 or 50 basis points, and that is a lot. So the 30-year fixed rate today, 7.31. The 15 years at 6.65%. 6.75 is the FHA 30-year. The jumbo is 7.35, and the 5/1 ARM is 7.07. As you can see, all of these rates are high in terms of what you're going to have to pay on a monthly. And it's quite a bit higher than it was 2 months ago. Now, what do we see? We see on the economic outlook about what's happening this week that the Fed is probably going to remain stationary, i.e. not raise the short-term interest rates. And that affects a lot of things in your life. Most of it is about your car payment, your credit card payment, and tangentially the mortgage interest rates. We're getting updates as we speak. And I think when you're out there and you're looking at whether this is for you and you're trying to decide, and I go through this all the time, whether it's in your life, whether it's with medical for older people, whether it's with retirement, whether it's with college, with younger people, financial decisions that you make concerning where you're going to live are, you know, they really involve a lot of stress, a lot of thinking, and, you know, quite frankly, you have to come up with the financial resources to be able to prove you can pay both. Either it's the rent for year by year, or it's the mortgage for 25, 30 years. How you do that, where you can figure that out, is all around these calculations that continue to rise. And if you are in that pool of people that I just mentioned, you have health, or you have college, or you have retirement, or any number of these things, you have to seriously look at where you are financially and how you're going to, you know, afford a new mortgage, or how are you going to get to your retirement? A lot of people's money is wrapped up in their house. Those people that are 60, 65 and older, there's probably 70, 75% of those people that own their house outright. How do you get the money out of that house at these decisions, especially when you see the mortgage interest rates the way they are and house prices the way they are? Everybody's waiting for the economic slowdown, right? And there's a problem with the model that says, hey, in order to cure inflation, in order to get lower house prices, we need to have a recession. That would please people with money, and it would please people who want to see lower inflation. But for people who are employed, it's not such a good thing, because people employed are always worried about jobs. Now, the latest threat to your job is artificial intelligence, right? This is what the Wall Street crowd loves, because it drives money to those businesses, which lifts the entire exchange. People who want to invest in companies that do artificial intelligence are the ones that want to make the next killing. But the homeowner, the person who wants to buy a home, and in these different things that you have to do to get money out of your house for the different things like, as I said, health care or retirement or any number of other things, they are troublesome, because you want to make sure you have a job to pay that mortgage in an ascending real estate price, and also ascending real estate mortgage price, the rate. So if you're worried about things about your job, that's a problem. People in my industry, the mortgage industry, artificial intelligence is one of those things that scares the heck out of people in both my business, in escrow, in title, in real estate. Why? Because the formula by which transactions happen is a by the numbers approach, which can be handled by other than a human. The human side is, hey, I have to talk to a person. I have to begin to understand where their needs are. I have to, understand how to communicate with them. Artificial intelligence is not there yet. Someday it will be, but it's not there yet. Worrying about your job, trying to get a mortgage, it's a very difficult and emotional process to begin with. And when you start to worry about the basics, like, okay, how am I going to be employed to pay this mortgage if I'm in a certain industry? All of these things are things to think about. Listen, I'm Jeff Barton, your voice in the mortgage industry. Thanks for listening to the show, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome, everybody. Welcome back. I am Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show. You know, if you want to see the show, we record this for video on YouTube. Jeff Barton, the Mortgage Voice, is our YouTube channel. Hundreds of shows there. You can look and see what we're doing and how we're doing it, not only for today, but for weeks past. We also have a Mortgage Minute that we try to get out on the air. I've been a little laxed in doing that. A lot of changes in my own particular life, as probably in yours. You know, one thing about life, you just have to wait a few minutes and it's going to change, whether it's in the mortgage rates, whether it's in the price of the real estate, whether it's in anything that you can think of. Kids grow up, they go on, they go to college, different expenses at different points of life. And as you go along and try to remain relevant in those people's lives who you love so much, at the end, what happens normally is that change, it just comes upon us and we try to adapt. And as in the mortgage interest rate that we're adapting to now, yeah, let's just get to that, because I have a few things I wanted to talk about. There is a Fed meeting this week, and we're maintaining the current rate that the Fed has, as everyone knows, between 5.25% and 5.5%, and that's the inter-day exchange rate that they charge member banks in order to be liquid. There is a liquidity requirement for all major banks that was set during Dodd-Frank. It's been adjusted several times, and certain categories of banks have been released from that particular requirement, but by and large, many of the top banks in the country have to borrow money on a daily. This affects many things. It affects your credit card. It affects your car loan. It affects tangentially the mortgage interest rates, as we have talked about. But there are certain people who look at the economy and say, we're going to avoid a recession. We talked about it in an earlier segment about what recession means and how certain things in the marketplace are changing, whether it's AI or whether it's other things in the employment market, whether it's whether you can afford a loan, whether it's products in different states that might not be available here. The economy itself and what's happening. I'm going to give you a synopsis. We've had opinions by Logan Metashami before. It's through Housing Wire, Sarah Wheeler's show, that I listen to quite often, because they have great guests, and the people that they bring on, although they're with Housing Wire, have great insight as to what's happening. Plus, they're educated people, and this is what they do. So bringing that information to you. On the flip side of that, and how the Fed rate affects you negatively, so I want to give this as a juxtaposition. One, the economy is one way. Two, the Fed is creating negative impact on a lot of people. So let's go to the positive first, because I think doing that will give you an idea of where we are economically and what this particular economist says about the economy. Okay, so in listening to the show, it's always, and you can go to it too, it's housingwire.com, and all of the audio and all of their shows are free, so you can just listen to them. If you want their daily update on information, you have to pay. But I like the free, and I listen to it. There's a bunch of sites that we go to prepare for the show, and this is one of them. The recession, why have we had none, is the topic that they are talking about on the show. So let's go through a couple of the positives here. The 10-year is at 4.32%. Okay, that's an investment issue aside from where we are in what the 10-year is. The unemployment rate is low. It's not yet, and they say that the 325,000 people filing for unemployment on a weekly is the number when you think the economy is doing poorly, i.e. there's unemployment happening. Well, it's way below that. It's 220,000, 215,000, has been steady in that range for a year, 2 years, maybe even longer. So unemployment is low. The GDP is good. Now, what do I mean by that? The gross domestic product, according to the Atlanta Fed, is going to be close to 5% in the third quarter of 2023. 5%? Hasn't been 5% since, I don't know, maybe the second quarter of Trump's presidency. How many years ago was that? 5? Yeah. So GDP is good. The household balance sheet is good. Now, what do I mean by that? Okay, everybody, whether they know it or not, is positive or negative on their expenses in their house, whether it's mortgage payment, food, rent, gas, whatever else you're paying. money coming in versus money going out, the balance sheet for most houses, it says here all houses, is good, meaning you're making more money than is going out, and that's a good thing. Number 5, the credit card stress, meaning okay. So we report on this show quite a bit about the different things in the economy. One of the things we've reported on previously, last couple of weeks, is the credit card debt in the U.S. is rising, and it's rising at an alarming rate, blah, blah, blah. Well, the stress on the credit card debt, on the balance of payments on a household is negligible. So even though we have an overall credit card debt rise, we are not seeing a growth in that differentiation between money coming in, money going out. So it just means that, yes, it is growing, but it is not affecting the household budget. And it's not affecting the balance sheet on a household basis. And that's good. Auto loan stress, okay, that is true. We are seeing auto loans stressed. But we've always seen auto loans stressed. They give car loans to anybody. And one of the things that came out of Dodd-Frank was the law passed in 2008 that really put the reins on what we could and couldn't lend on mortgage-wise. And it really made the front end of the mortgage, the origination they call it, when you go and talk to your loan officer and you fill out all the paperwork and you give them your income and your credit and all the things that they need to do the loan, that part of the loan process, because of Dodd-Frank, is great. And it's called a qualified mortgage. Well, they never did that with auto loans. It was part of the package to mollify the car industry. Should there have been a QM, a qualified mortgage? Should you be proving that you can pay off that debt? Yeah, probably, but it's never been that way. So that's not a good thing, but it's always been like that. So it's not considered a negative. Rental sales are good. New home sales are up 20% year over year. This is what's happening on the positive side. On the negative side, okay, if the Fed raises rates, which they're not going to do, they may do next time, but they didn't do this time, average credit card is 20%. It's an all-time high right now because of the Fed rate. Mortgages are 7%. Now, not directly because of the Fed rate, but it does affect tangentially. Auto loans are 7%. That absolutely is affected by the Fed rate. Student loans, which, by the way, are going to suck money out of the economy, which will drive the GDP down. You don't think it's a lot? How about $1.5 trillion that's owed? It's having to be paid. I think it was last month. The deposit rates, which I wanted to talk about, is one of the positive things here. Deposit rates, as I said, on the 10-year was 4.33. On the 2-year is over 5%. Last week I went off and said, hey, look, you should be thinking about investing in 2-year treasuries. 2-year treasuries at 5%. Where are you getting a 5% return? Let's say you own a home and you're renting it out. Are you getting 5%? Are you having the headache of having to fix something? Are you having to manage long distance? Are you looking at that investment? What is your actual true cap rate? Well, here 5% is looking pretty good, taking money out of the economy, thus slowing the economy down, which would help inflation. The Michigan consumer sentiment we talk about all the time, it falls to 67.7%. Anything over 50% is positive. The Michigan consumer inflation sentiment falls to 3.1%. That's a good thing. The 5-year inflation sentiment falls to 2.7%. That's a good thing. So people out there are saying, you know what? I think the economy is going to be good. It is good, 5% GDP for Q3. And I think that the inflation is going to be good. These studies show, not these studies, but these consumer sentiments show, hey, that's correct. So we've got a juxtaposition of what's happening according to Logan Matashami and what's the reality according to how the Fed rate hike affects you. I just wanted to give you this look at how we see the economy and why it's confusing and why rates are still high, because banks are still nervous. I'm Jeff Barton. This is The Mortgage Voice. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening to the show, tuning in each and every week. You know, you can see and hear us many, many different ways. One of the ways is podcasting. Our podcasting is with Spreaker, Stitcher, iHeartRadio.
Yeah, we've got radio.com and we've got Apple Music.
Apple Music Play and podclips.io, as well as themortgagevoice.com. You can go to all these places. We have many ways by which you can see and hear the show. If you want to just join in for any reason, you can go to themortgagevoice.com. You can look at the guests we've had on that week, or for the past few weeks, you can contact them directly or contact me. Great way to stay involved with the show. And again, we're on YouTube as Jeff Barton, The Mortgage Voice. Bringing to the show once again, Wendy Van Wessel from Kind Lending. She's kind enough to join us here again today to talk a little bit about what's going on in the mortgage industry from her perspective. Wendy, how are you?
I am just fine, Jeff. And yourself?
I'm okay. Thank you very much. As Wendy well knows, I am transitioning to a different type of work, although I'm still in the mortgage business, certainly in the radio business, trying to bring to you information. One of the things I've seen in stepping back a little bit is that the overall nervousness in the market is strong, and we see lenders not wanting to lend, i.e. the way to get a loan and how to get a loan. The underwriting is a little bit tougher, and certainly the rates are like that. What are some of the programs or some of the things that Kind is doing to help either like calm down the market in terms of one-on-one loan, or some of the product offerings you might have?
Well, first of all, this industry is a little bit stricter. You are correct. Fannie and Freddie are asking the lenders to buy back many loans.
Yeah, I saw
for
that.
small,
Yep.
tiny reasons, yeah. Regarding the programs, we do have a Cal HAFA program,
Okay.
which is a first, either at 97% or at 96.5%, and then either the 3.5% or the 3% would be a My Home Second. So it's 100% financing. You just need to come in with the closing costs, and that's a My Home Second. They're all hoping that the dream back, that it will come back as a lottery, which was a second from HUD that didn't need to be paid back. Now that is changing quite a bit, probably not until next year.
Right.
And it's going to be a lottery. Now they're changing the rules.
A lottery?
Yeah, it's going to be a lottery. That was interesting when they said that. Even Molly from Cal HAFA was not quite 100% sure about it yet.
Well, that sounds like it's ripe for some kind of fraud. I mean, what, somebody's running a lottery, right? So obviously somebody's deciding who wins the lottery and who doesn't. That just
This
doesn't.
time the legislature hasn't even allocated the $2 million worth of funds that were supposed to be set aside for it. But we do still offer the My Home Second, which is a 1% simple interest, and it doesn't need to be paid. It doesn't need to have payments on it. Doesn't need to be paid back until you sell your home or refinance, and that's a 1% simple interest. So that's not a bad deal at all for 100% financing for people out there right now.
No, and
Cal HAFA's rates are like low sixes. Not bad.
now in that 1% interest, is that compounded on a yearly?
Nope, it's just flat. 1% of the loan amount. If you have a $350,000 loan, is $3,500, right?
Yeah, is that on a yearly or is that just one-time fee?
That's just the one-time fee.
Oh, well, that's a great deal. Well, that's free money.
Almost. Yep,
Yeah.
almost. And then if they refi, they need to pay it back.
Sure,
which
of
I think
course.
is fair.
Of
To
course.
get them in the house. We also, I don't know if people are doing, I think we have to in California look at our jumbo pricing.
Mm-hmm.
And jumbo loans, we offer 6 of them, and 2 of them, Elevate and Elite, are pricing pretty darn well. I would say in the high 6s, low 7s, which isn't bad for a jumbo loan at all.
Okay, so Kind is doing jumbo. You know, so many of these companies have gotten caught at 3% jumbos or 4% jumbos, and they just can't either monetize them to replenish the mortgage pool, or they're just stuck with them. And so U.S. Bank is a perfect example of a company who is, you know, having some difficulties because of the fact that they can't get rid of these, and therefore they have liquidity issues. What are you doing at Kind Is it just because you think this particular rate will go down at some point, or?
Our investors are interested in them at the high sixes, low sevens.
Right.
They think that, and actually, yes. So the Vibe event that we're going to have on October 24th, which Glenn Stearns put together, the owner of Kind Lending,
Right.
it's going to have Barry Habib, Grant Cardone, Manny Ishbin, John Elway, Glenn Stearns himself, and Plum.
Who? Are you there? Wendy seemed to have missed it, but she was talking about an event which is put on. Are you there, Wendy?
I'm here. Can you hear me?
Yeah, it just disappeared a little bit. So you were talking about the event, and I was just filling time here on the air while we tried to get you back. Just explain a little bit about what the event is and how people might be able to attend.
It's free. If they contact me, it's in Costa Mesa at the Westin Hotel. It's all day on October 24th. And it'll have, did you hear who was going to be there?
Yes, we heard up till Glenn Stearns being there, and then you cut out.
John Elway.
Okay.
And also the prisoner of war. I think his last name is Plum, and I'm so bad that I forgot his name. He's such a nice man. It's about the mindset for 2023, 2024. I think that everybody's thinking now, I think Barry Habib thought September the rates were going to start to go down. He forgot some important data in there, the used car sales data.
Right.
And now he's predicting, or they're predicting, the end of the first quarter or the middle of next year,
right,
that the rates will go down. So now you have a chance to get those homes that are out there. If you still want them, there's rates that are okay, knowing that in 6 months you can refinance into a lower rate if you want to. But don't think that there's nothing out there, or don't think we also have standalone seconds. You have a lot of equity in your home now.
Yep.
If you need to pay down your credit cards that are in the 20s or wherever they are now, you can get a rate of, I think, about 10%, 10 and a quarter, 10 and an eighth, up to $350,000 if you need to do something to your house so that you don't have to go away on so many vacations, or if you need to just pay down those credit cards. That's out there, too, for you to tide you over.
Now, the main thing that we were talking about earlier in the show, in a couple of segments I did, was the employment, how employment is going to be affected by certain things in the marketplace, and how the long-term effect on mortgages and the ability to get a mortgage is affected by things like AI, by automation, by layoffs. If, in fact, the recession ever comes, there'll be additional layoffs. Is this one of the reasons why it's more difficult, and why Fannie and Freddie are being so, well, not picky, but certainly more strict on their purchase requirements?
I think that they are wary to not have buybacks, to make sure that they have a strong candidate there. So those people, and then you have the opposite, the non-QM stuff that's so popular now, right? So for conventional and for FHA, they're looking to make sure that they have the right DTI, that everything is done. For example, if you have an appraisal that has a score of C4 or higher, C1 being the best and C4 being, well, you got to kind of look at it. They're automatically tagging that and making sure that everything is scrubbed and just looks perfect. So you have to have a property that's in a good condition. I wonder what happened to those 203Ks, which were the loans that you could get money to repair the home. I haven't heard so much about those right now. So
nope,
C4
I haven't either.
appraisals. Yeah, there should be some monies to repair some of the houses out there, since we have such low inventory too.
Yep, all that's true.
I don't hear that, but about the layoffs and things like that, yeah. I mean, written VOEs are likely to continue, right? Can your boss say on your written verification of employment that your employment is likely to continue, because that's one of the things that you do need. Now we have the non-QM side, which is filling that gap a little bit.
Sure,
they're becoming
it is.
more popular, because the way you do your taxes, so you don't have to pay so many taxes, might not be what you need to get your loan. So that's 12 months worth of business or personal bank statements, a profit and loss from your CPA. You can even do, if you're lucky enough to be in that position, at asset utilization. So there's options for you not to have to do taxes and pay stubs.
Wendy, thanks a lot. Hey, listen, I'm sorry to cut you, but we're at the end of our time, and I really appreciate you coming on again. There's so much I'd like to talk to you about, so we'll have you back soon. Thanks very much.
It's always my pleasure, Jeff.
Yeah, let people know how they might be able to get in touch with you, especially if they want to talk about that second product.
Sure. My name is Wendy Van Wessel with Kind Lending. My number is 818-292-2572, and if you want to go to the live event, just let me know.
Excellent. Thank you very, very much. I appreciate it.
Thanks, Jeff.
Thank you. That's Wendy Van Wessel from Kind Lending. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show, for listening each and every week as we try to bring to you useful information. I know some of the stuff we talk about is esoteric, meaning that you have no idea what I'm talking about, which I understand because I can go on a tangent like I'm doing right now. However, a lot of it has to do with the psychological effects of whether you want to buy or you want to sell or you want to refinance. Some of it has to do with the hard rate that's out there. Some of it has to do with the boogaboos that are out there, whether you're going to lose your job, maybe. You're going to, have to pay a debt. You're going to worry about other things other than the specificity of what you need to do when you're focused in on buying and selling real estate. To help us through some of that is, back to the show once again, is Connie Hernandez from PMA, and she joins me now. Connie, how are you?
Fine, Jeff. Thank you for having me.
Thank you very much for being on the air. Okay, so we try always to try to boil it down to make it simple. In silly season, which is the election season, which we're getting into, people get lost in either Facebook or TikTok or any number of other different social medias, and they lose focus on what is important to be able to get that loan or get that property. How do you focus people when they say, hey, look, I've been looking for 6 months, I can't find a house? How do you refocus them on what their goal actually is and block out the rest of the noise?
Well, it's a little tough. I'm sure everyone can share in the same experience. Simple things like reminding them with emails, with texts, things that they need to do to stay on track. Whether your client is looking to purchase, to make sure they don't go out and spend any money on those credit cards, that their credit doesn't change in any way drastic, and to always keep you informed as to situations that are going on at work or even at home. Just, those quick hello texts, even though you're still looking for a property for them and nothing's come up in a month, not a good idea to wait that full month to touch bases with them again. I personally, myself, if I am working with a client and I am handling their loan, I usually try to stay in touch with them at least, honestly, minimal once a week. If I can touch bases with them twice a week, that's even better through the loan process. And sometimes there really isn't an update or there isn't anything I really need from them. I'm just kind of sharing some information with them, letting them know that, we're constantly monitoring the rate. We're not quite, I'm sorry, hold on.
No problem. And so
that alarm went off. I'm sorry.
No, that's quite all right.
Constantly just kind of keeping them in the loop and making sure that they know that you're constantly on the lookout for their best interest.
I love it. Bad news happens. It just does. In an economy like we have right now, which it's so funny because statistics will tell you one thing, but the daily where people live, where property, not only property prices, but price of gas, price of food, seems to be doing the other. It's hard to keep people focused. And how do you keep them from going down the street to say, hey, well, maybe you have something better to offer? Obviously, people shop. That's just what they do. But customer loyalty based on, communication skills of you, the loan officer, the real estate agent, are really what's at the core here. And it's that type of market where people are looking for best advantage and get sold stuff all the time. Even though it may not be their best advantage, they just like what they hear.
You're absolutely right. And unfortunately, because business is not as, as it was I would say a year ago, right? A year ago, we were still busy, pandemic or no pandemic, we were still busy.
Right.
And not to say 4 years ago, we were slammed. The phones were ringing all the time. And so now with that not quite happening, I think your skills, your knowledge in the business, and your customer service is key to keeping those clients from wandering off. And also, something that I've always prided myself on never speaking ill of anyone else in the industry.
Right.
But I always say, buyer beware. Sometimes things that seem too good to be true, maybe not quite so true. So with that being said, you always want to make sure that sometimes, unfortunately, during these times, they're going to hear things that may not be accurate. So if it sounds too good to be true, I would definitely do more research.
No, I think that's good advice. And not speaking ill of other people has always been a way by which I did business. If I know something, if I, have a way by which I can tell somebody, I don't. I just keep it to myself because it always comes back. There's always some darker side to being negative, and it's just not who I am. So let's switch gears a little bit, talk about programs, what you see out there that might be helpful for people who are looking to buy a house, even though the rates may not be the best they am. Maybe some of the programs are.
Well, honestly, right now, some of the programs that we're really focusing on are reverse loans.
Okay.
Those are still, something that our clients need. And for those people that are having a little bit more difficult time qualifying with traditional rates with Fannie Freddie, there are still plenty of non-QM products out there, which, of course, the rates are not attractive right now, but
sure.
The goal is to not throw your money away every month because rents are not getting any cheaper either. So it's worth it if it makes sense financially to always invest your money in real estate, knowing that there may be an opportunity to refinance later and improve that mortgage payment.
Okay, and I agree with that 100%. I think that Fannie and Freddie have tightened their restrictions and the buybacks have risen. It's driving people to the non-QM market, which is more expensive. And I think that is a solution, especially when you're looking long-term, 2, 3, 5 years down the line. Rates will probably be lower at some point during that, and refinance is always the way to go when, in fact, you have a higher interest rate like 7, 7.5%, 8%, 8.5%, or even this hard money stuff, which starts at 12 to 14%, depending on the profile that you have as a borrower. What are you seeing as profiles from borrowers right now? Are you seeing more people looking for hard money, more non-QM, or are they all going conventional, or is it mixed?
Well, I would say honestly right now it is mixed. We have focused for many years working with law enforcement, also fire department, school
sure.
teachers, and they have very stable jobs. And, there are still some areas, some markets which, are, even though the interest rates are going to be in the mid-6s, maybe potentially even low 7s, because we're still using a low down payment, their income, if you prepare them, could still satisfy what needs to happen in order for them to qualify for their loan. And what I mean by preparing them is letting them know, some of those debts might need to be paid down, they might need to be paid off altogether, so they can focus on making sure that their debt ratios are going to work. So it's going to take a little more time, a little more effort to help those borrowers through this process of these high rates. But, one of the things that I always share with my borrowers is, in reality, the rates are what they are, but whether they're high or whether they're low, if the objective is to pay the bank less money, then send a little extra whenever you can. And that definitely will affect your interest rate long term.
Yeah, I think that's sound advice. Out there in the marketplace, trying to find solutions for people who, obviously want to buy a house, house prices. Now, you're in West Covina, yes?
Correct, Covina, West Covina.
Okay, Covina, West Covina, and you service all the Inland Empire and the people in our listening audience, San Bernardino and Riverside areas. Real estate prices there continue to rise. It's a phenomenon of this particular market. Don't see it abating anytime soon. Don't see a recession on the horizon anytime soon. So where are we heading? We see that obviously new homes have gone up by 20% this year in terms of sales. But what's the solution here for some of these people who want a home and the prices keep rising? Yeah.
You know, it's kind of encouraging to see that in many situations, families are actually coming together, Jeff.
Oh, yeah.
And
Okay.
helping each other qualify for property, knowing that it's an investment for both, and that sometime down the line, when they've built enough equity, they'll both walk away from that property and share the growth of that equity, or by paying it down, that's also going to help them grow that equity. So at one point, they probably will go their own ways, but for the meantime, they're sharing a home. And I'm seeing that more often now than I have in a long time.
That's a great solution. We've come up against a time here, but I want to have people get in touch with you because that's really a good solution for a lot of people. If you could let people know how they can reach you, that'd be awesome.
Oh, absolutely. Thank you. And
sure.
Yes, they can reach me. My direct line is 626-422-2017. I'm Connie Hernandez, and our office is located in downtown Covina on the corner of Citrus and Badillo, 101 North Citrus Boulevard.
Connie, thank you very much once again coming on and really helping me out in all these areas, because business is changing, and the way we do mortgages, trying to hold people, in the deal and make them feel good about it. Yeah, that's what you do really well, and I appreciate you coming on the show.
Oh, thank you for having me, Jeff. Always appreciate you on the show.
Excellent. That's Connie Hernandez from PMA. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening each and every week. You can see the show, hear the show on YouTube, Jeff Barton, the Mortgage Voice. You can hear it at the KCAA website. I want to say hi to all those people who bring us to you, San Bernardino and Riverside counties, some parts of Palm Springs, all the way up the 15 and all the way down the 15, too. We sometimes get heard down in Temecula area, and certainly in LA and Orange County as well. I'm Jeff Barton. This is The Mortgage Voice. And again, thank you very much for listening to the show. We have talked to a couple of people today who are in the lending business, a lot about the touchy-feely side of the industry, because when people don't get what they want, i.e. a low interest rate and an easy way to get the money, it turns very stressful. Usually having a very direct path to be able to ask questions, get them answered, and have those answers be true all the way through the loan. A lot of times you'll get loan officers who'll say, yeah, I can get you that rate. And then, of course, when you're ready to lock, the rate turns out to be a quarter, half point higher. And you're like, well, what the heck? And they say, well, markets change. I never said blah, blah, blah. Well, that type of information, knowing up front, is really the best way to get into any loan. The lock that you have on that particular rate is always the way to begin the conversation. In order to secure the financing that we're talking about today, we need to lock this loan ASAP, and here's the path to do that within X amount of hours or days. That is the exact way that you need to hear it. Now, many of the borrowers, you included probably out there, are thinking, well, I don't really know what I want, and I don't know if I want to commit that soon, because there's no trust in the deal. So in talking with the loan officers and the people from Kind Lending today, we talked about that. How do you gain trust from the customer? How do you be able to establish your credibility so that, people who are naturally nervous, I mean, in the political climate, in the economic climate, and I don't know anybody who hasn't been catfished or been on a fishing expedition whereby people are calling you and telling you and saying, oh boy, you have this wrong with your computer, you have that wrong with your website or with your social media, that you haven't clicked on the wrong email or clicked on the wrong text, and all of a sudden everything goes dark. Happens to all of us. So the mistrust in the marketplace is obviously there and very high. So the process by you as the consumer, you're out there, you're trying to figure out who to use or what to trust. You have to begin to have a conversation with the people that you're doing business with so that you develop this trust. And you have a sixth sense about it. Most people do. Most people have a very good sixth sense. If you're one of these people that knows you can easily be talked into something, then you need somebody there with you to help you make those particular decisions. One of the things people get involved with is debt. Now, what do I mean by debt? Yeah, I want a car. Okay, I want a car. I want a house. Okay, I want a house. I want to buy that refrigerator. I want to buy that new furniture. I want to have a pool. All of these are things you want right now. Well, most people don't have a bank, a pile of money in their account to be able to just spend and buy. They have to borrow that money. And borrowing that money is what debt is. How you get approved for that debt is different for each company you're indebted to, each loan company, each, particular thing. Now, we talked earlier in the show about auto loans. To get approved for an auto loan, you need a heartbeat, and that's about it. I think you need a job. You need a credit score above, 640, maybe 620. But it's easy if you have those two things to get a car loan. It is not like getting a house loan, a home loan, a mortgage loan, where you have a list of things that you have to qualify in order to not only get that loan, but get the best rate. And those things are, what debt is. Debt gets bought and sold on a daily. But I wanted to bring to you a little bit about what debt is and how, when we talk about debt, because I think people get a misunderstanding when big numbers are thrown out there in the world and people get nervous. This is part of the psychological warfare that is used during silly season, which I consider, now we're, a year and a half away from a year and a month, 2 months away from the presidential election. And, people get worried and scared and start to fret about things. So, okay, let's talk about the worldwide debt. All right, this is a number that will just twist your noodle. Okay, the worldwide debt. Darrell, what do you think the worldwide debt is?
$25 trillion.
That would be a no. The U.S. debt is $32 trillion. But the worldwide debt is $307 trillion.
That was a little off.
Well, nobody knows what that number really is. And believe me, to me, it's not real either. And one of the things about when you're discussing debt, and we talk about it in the mortgage industry all the time, you're not talking about the money that you owe, the whole money that you owe. What you're talking about is, what do you owe every month? Can you make the monthly payment? Okay, so as I said, the U.S. debt is $32 trillion. Chinese debt is a little higher, but those two economies, those two countries have as much debt as the rest of the world combined, easily. But still, it's about what I said. It's your monthly payment. So on its surface, the U.S. economy, the GDP, is about 35 trillion, a little bit more. So our capacity is not yet 100%, 1-to-1, meaning that our debt is what our GDP is. But really what we're talking about is what's the monthly. We're not going to cut it down to the monthly, what the U.S. government pays on a monthly, but we'll cut it down to the yearly. On $32 trillion, the U.S. pays on debt service, i.e. your mortgage payment, right? This is the U.S. mortgage payment, $395 billion. $395 billion is what we pay to the debt service. To give you an idea what that is, what $395 billion is, the U.S. every year defense spending is $895 billion, almost $1 trillion that is spent on defense every year. Our balance of payments, our payments on a yearly basis, $395 billion. So managing that number is what the debt is for us. We're all taxpayers. We all pay the debt every year. We pay the debt service through our taxes. But that's what when looking at what the monthly is, this is $395 divided by 12, whatever that is, so it's about $34 billion a month. Now, granted, That's a big house if you're looking at a mortgage payment, right? That's like as big as the Google house. Everybody's seen their house, right? The two people that own the two people that own Google, a 150,000 square foot house or something. Or whether it's Beyonce and Jay-Z's house out in Malibu. What is that, $195 million? Is that what it was?
Crazy, just crazy.
It's insane, right? So these numbers that we've all become accustomed to, that nobody can afford to really understand. So the debt to GDP ratio here in the States is 97%. Big numbers supporting the debt. The big numbers are the U.S. economy, what the GDP is, what the growth is. So the debt, is it bad or is it good? Several things say debt is not bad. The growth of debt may be bad, and the balance of payments may be bad. And when they talk about money we owe, slow down spending, that's what they're talking about. To slow down the growth in spending so that this number doesn't get so big that if we have a problem, we're not adding to the deficit, which is really adding to the monthly mortgage payment. You're buying a bigger and better house when you have more debt. There's only two ways to control that. Grow the economy, stop spending. And this is what the fight is a lot between one side versus the other side. One side says, no, we can grow the economy, and at the same time, we're going to cut spending. And these are good for consumers, for people. The other side says, no, we need to, have bridges and roads and things that we need, hospitals. And so we need to continue to spend in order to provide for the basic needs of people who live here. Though that's the basic right and left look at what's happening. Economically, currently, we're okay in terms of paying the balance of payments. Growing the economy to offset debt spending. That's really been the basis by which we've been running this country for some time. Now, I haven't got time to get into why Chinese way of doing it is different and how that difference really spells doom for that particular way of thinking. We will next time. I'm Jeff Barton, your voice in the mortgage industry, and we will see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
Moreno Valley, Corona, and Riverside. Listen to KCAA